Hey, hello friends. Welcome back to my YouTube channel 30CAGR. Today, I came back with an extremely important topic about peak margin rule. How should option sellers trade after this rule starts kicking in? After September 2021, option sellers need to pay hefty margins for short straddles, short strangles, or even for naked positions. So in this video, I'm going to discuss about all those things. And I decided to add this as part 4 of ISS strategy. This is the most important of all those videos I released as part of this series. And even if you are not following ISS strategy, this is still useful for you if you are an option seller. So please make sure that you watch the video till the end. But before we begin, if you haven't watched ISS Strategy 1, 2, and 3, I highly suggest you to go watch them and come back because this is the strategy where you consistently earn 4 to 5% returns every month, even after this peak margin rule. So yearly you have an opportunity to make around 60 to 70% of the returns, and in some cases even 100% returns per year. And it's extremely safe as we have included all risk management measures in this. So if you haven't watched, I suggest you to watch all those 3 videos and then come back to this part 4. My name is Raj and 30cagr.com is my blog. I have two important strategies in this blog. One is ISS strategy wherein you make consistent monthly income, and then the second is PDR strategy wherein you make a decent 30 to 50% returns every year in short-term equity trading. And the best thing about PDR strategy is number one, it acts as a good diversification strategy for your entire portfolio. And then the second is you just need to spend 1 hour per month. So if you are a working professional, this will be extremely useful for you because you just spend 1 hour and make 30 to 50% returns every year. So both these two strategies are explained in detail in my blog. Feel free to visit my blog or you can also search my YouTube channel. And lastly, I'm also offering free trading bots for these two strategies. So all you have to do is just open a demat account and get the bot for free of cost. Sit back, relax, and the bot does everything for you. Just go to your account and look at the profit and loss at the end of the day or end of the month or end of the year. For details of the trading bot also, you can visit my blog 30CAGR. All right, before we jump into this extremely important topic, make sure that you subscribe to my channel if you haven't done already, and don't forget to hit on bell icon. All right, first discuss a little bit about the basics and then we move to the main part. Peak margin rule. What is this peak margin rule and how is it going to affect our trading as option sellers? Let's not really discuss about the calculation part of it, but the main intention why SEBI introduced this peak margin rule is to protect the broking firms, in fact, and of course, investors as well. Especially during huge market fluctuations, investors face a lot of loss if they take so much of margin from the broker. And it is risky for broker as well because sometimes clients run into losses and they don't pay back to the broker. So in those cases, even brokers face huge losses. So to overcome these two issues, SEBI has introduced this peak margin rule. But how is it going to affect us as option sellers? As option sellers, it is going to affect us heavily because now you cannot avail any sort of intraday leverage or extra benefit from brokers. Remember, be it options or futures, already some margin is included in that. It's inbuilt. And on top of it, brokers are giving us some more margin or leverage for intraday trading until now. Let me show you an example. Let's say you want to sell one pair of short straddle currently. So one short straddle is one call option and one put option. So you sell both call option and put option, and the margin required for this is 2 lakh rupee if it is in NRML, which means if you want to carry forward this, then you need to pay 2 lakh rupee to the broker. However, if you want to do it in MIS, which means intraday trading, you enter and exit on the same day, then you just need to pay around 40,000 to 50,000 rupees till now. But going forward, it will be 2 lakh rupee for intraday trading as well. So there will be absolutely no difference between NRML or MIS. Option sellers cannot avail any sort of extra margin benefit even if they trade intraday. So this is a huge change for us, right? Because let's say earlier you used to pay 1 lakh rupee for one lot of short straddle in intraday. For demonstration purpose, let me take 1 lakh as margin. Or for that matter, even in ISS strategy, even before this rule kicked in, I always asked my clients to have at least 1 lakh for one lot of short straddle. This really helps us in risk management. Anyway, so let's say earlier it was 1 lakh that you need for one pair of short straddle, and after 1 year you were in a position to earn 1 lakh profit. So this is the capital and this is the profit. In this case, your profits are 100%. Now going forward, you need 2 lakhs capital instead of 1 lakh. But your profit doesn't change, right? Your profit will still be 1 lakh. So in this case, your profits are falling down to 50%. This is one problem that option sellers face. And the second problem is, even if this is fine by you, you still need to have 2 lakhs. So if there is any client who has just 1 lakh, he cannot start his trading in short straddle going forward because broking firms will not accept any capital less than 1.8 or 2 lakhs. So if you are a small trader with 1 lakh capital, you are kicked out of this game. So these are some of the difficulties that we are going to face after 100% implementation of this peak margin rule. Now, let me ask you one thing. I've been hearing a lot of aggravated views from traders saying that this is a bad move, why SEBI is doing all this, SEBI is favoring only big traders and all such sorts of things. But let's step back and think once, is it really a bad move? But let me tell you, this is not really a bad move if you understand risk and money management concepts well. In fact, I am very happy that SEBI has taken this decision. Two main reasons why I'm not really worried about this is first, drawdowns. If you have watched my videos earlier, you would have already known that I kind of always focus on drawdowns more than returns. Of course, yes, returns are important, but drawdowns are even more important because in stock markets, first thing is to protect the capital and second thing is to earn money. So capital protection always comes first and then comes earnings. So now because of this introduction of peak margin rule, we are deploying 2 lakhs capital and our returns will of course come down by 50%. But our drawdowns on the other hand, we call this as drawdown or max drawdown, will also come down by 50%. Earlier it was 1 lakh rupee profit and let's say 20,000 is the drawdown or 20%. Why? Because earlier it was only 1 lakh capital. But now since we need 2 lakhs capital, our drawdowns will also be 10% in terms of percentages. Earlier it's 20%, right? Because we needed 1 lakh capital. But since we are doubling the capital, drawdown will be just 10%. And in case of profits also, of course, as I said, it will be 50%. Now imagine you are trading with 2 lakh capital and you just lost 10%. You still have that confidence and you don't keep jumping between the strategies because the most unfortunate thing that happens with 99% of the traders is they keep jumping from one strategy to another strategy. If you read books about trading and investing, what veterans or experts in this field say is before switching between strategies, at least ensure that you take 25 trades or at least trade for 3 months. Only then you get to know whether that strategy is really bad or good. But unfortunately, 99% of the people do not do that. They keep jumping between the strategies. That is because they are facing huge losses. Now that we only have 10% drawdown, you will still have confidence to go ahead and trade in this strategy even if you face consecutive losses. So that's one huge advantage with this. Earlier, whoever had 2 lakh capital, they used to trade in two lots, and 20,000 is a drawdown for each lot. So for two pairs, it will be 20 into 2, 40,000, right? And once you see a loss of 40,000 in your account for a capital of 2 lakhs, there is no way the trader is going to stick with the same strategy. But now for 2 lakhs capital, you will maximum get a loss of what, 20,000, which is 10%. So you will still stick with this strategy and you will trade comfortably in this, even if you have a series of losing trades. And then the second is option sellers will be converted to option buyers. This happens because most of the people do not have 2 lakh capital to enter into trades. Going forward, you might see there will be an increase in option buying and a reduction in option selling volume. But this is good for us because we are option sellers, right? We need more and more option buyers so that we can enter into best prices. The slippages would be less if there are more and more option buyers. So if you think about it from risk and money management perspective, this rule is really good for us. And as I said, the only drawback is this. Your returns might come down to 50%. Now let's talk about this a bit. In fact, this is where I want all of you to focus. Earlier I said there are two issues with this peak margin rule, right? One is our profits will come down. Now profits fall by 50%. Now the second is even if someone's okay with this type of profits, still they cannot enter as long as they don't have a capital of 2 lakhs. So small traders who have capital less than 2 lakhs. We are going to address these two important points in this video. First, let's discuss about profits. What are some of the ways that we can increase our profits? First is I'm introducing seventh rule to this ISS strategy. If you had watched my part 1 of this strategy, I told there are 6 rules to successfully earn profits in ISS strategy, right? These are the 6 rules. Now I'm introducing seventh rule to this called trailing stop loss. Yes, this is really going to be a game changer going forward for people who are trading in this strategy. Every time your option runs into profit, we are going to trail our stop loss. What this is going to do is two things. One is it is going to increase our profits by around 10%. And on the other hand, which is very important, it will get down the drawdowns by almost 25%. Okay, on one hand we are already bringing down these drawdowns because of this peak margin rule, and on top of it we are introducing trailing stop loss, which further gets down the drawdown. So on one side we are increasing the profits, and on the other side we are bringing down these drawdowns. And those who are availing this free trading bot from me, they will get this trailing stop loss feature absolutely for free of cost. And remember, manually it is impossible for you to keep trailing your stop losses because sometimes market moves very fast and you need to keep trailing your stop loss manually. And this might happen on both the sides CE and PE. This trading bot will do that for you. All you have to do is just sit back, relax, and let the bot trail the stop loss for you. Because if you keep trailing the stop loss, one advantage is you can ride the profits as long as markets go in your way. And whenever market turns back, then you will exit from the position. And remember, one other important reason why I'm introducing this trailing stop loss is when we have wild swings in the market, those are the days you lose the max, right? In part 1 I told you that if market goes continuously up or market comes down continuously, in both these cases you obviously get profit because one side stop loss of 40% gets hit and on the other side you get profit. And even if markets are in the range bound, you will still get profits because of theta decay. Now, only one scenario where you get maximum loss is first markets move up and then it might hit stop loss of one leg. Let's say C stop loss got hit, and then markets again come down and then hit stop loss of your other leg PE as well. These are the cases when you get loss on both the legs. Now think about it. If you introduce trailing stop loss, whenever markets move up, your SL gets hit on CE side. However, on PE side, you are in profits, right? Because we are entering into a short straddle. Now, because your PE leg is in profits, the stop loss will be trailed. For example, let's say you entered at 100 rupees for CE and then 100 rupees in PE as well. Now, let's say for both these, stop loss is 140 rupees. For CE, it is 140, and for PE also it's 140. Now, if market moves up, this call option starts going up and this put option starts falling, right? And let's say this call option went from 100 to 140 and then it has hit your stop loss because your stop loss is 40%. On the other hand, this PE which started at 100 rupees, this might go till 60 rupees. Now we don't worry about the call that has hit the stop loss. That's fine. We cannot avoid stop loss hitting in the market. So let it hit the stop loss. Whereas in the other call where we moved from 100 rupees to 60 rupees, we trail our stop loss from 140 to let's say 120 or 110 or even 100. Okay, it depends on how aggressively you do stop loss trailing. And even if markets come back, it can only hit the trailing stop loss of 120 rupees but not 140 rupees because we have already trailed our stop losses. So what we are doing here is we are minimizing our losses, which is very important, which is why the drawdowns are falling down by 25%. And this is extremely important. And as I said, this is going to be a game changer in terms of risk management. So as I said, first thing that we are going to do to increase our profits is introduce trailing stop loss. And then the second thing that we are going to do is I'm going to do a lot of changes to this strategy. Yes, keeping this peak margin rule in mind, we need to do some significant changes so that we will still remain in huge profit at the end of the year. I'm not going to discuss all those things here. I have reserved that part only for people who are using the trading bot. But all I can say is, in case if you are not using my trading bot, that's still fine, but nothing will happen. Just remember that your profits will come down probably to 40% to 50%. Even this is not bad, right? Earning 40 to 50% using a simple strategy is really good. So go ahead and continue doing that. But whoever is using this free trading bot, they are going to experience a significant change. They are still going to get a huge profit of around 70%. And in fact, if they are able to take a little bit of risk, then they will get even 100%. In fact, more than 100%. So I'm going to give them the option whether they want to go with plan A or plan B. I have both of these plans included in the bot. It's up to them. If they want to stay extremely safe, then they can simply choose plan A wherein they get 70% return. But if they want to take a little bit of risk, then they can choose plan B where they get 100% returns, which means for 2 lakhs capital, they are going to get 2 lakhs even after implementation of peak margin rule. And all this with a lesser drawdown. Drawdowns are going to come down to just 10% going forward. So at any given point in time, they are not going to lose more than 10 to 12%, and they are going to get 100% if they pick plan B or 70% if they pick plan A. So as I said, I'll just reserve this only for my paid members, and others can still go ahead and use this ISS strategy. And I think you all are already aware of the fact that I am giving this trading bot absolutely for free of cost because I don't want to charge anything from small clients. So what I've done is if you open a trading account in LS Blue, Angel Broking or any other broking firm using my referral ID, I'm giving this trading bot absolutely for free of cost. So you don't need to pay anything to me. And talking about these broken firms, please note that I stopped recommending Zerodha or Upstocks these days. Many people are coming back asking if I can provide the trading bot for Zerodha or Upstocks. Yes, I do have bots for this, but I stopped recommending because these guys charge a lot for API charges every month. API is some kind of technology that connects both our trading bot and their terminals. For us to use the technology, Zerodha charges 2000 rupees per month and Upstocks charges around 1000 rupees per month approximately. So you end up paying 24,000 rupees per year. Already we have these peak margin rules and our profits are coming down. And on top of it, if you pay 24,000 rupees, then your profits will further come down. So I am not recommending Zerodha or Upstocks unless you have a very high capital. If you have a very high capital like 10 lakhs or 15 lakhs, yes, definitely you can go ahead and trade in these two, because with 10 lakhs you are earning 10 lakhs, and in front of 10 lakhs profit, 24,000 doesn't really matter, right? So you can still go ahead and do it in Zerodha. Otherwise, I would suggest you to open an account with LS Blue or Fires or Angel Broking. These guys are offering their API for free of cost, and so on one end you can save 24,000 towards API charges, and on the other side you can also save around 25 to 30,000 for my trading bot. So a total of almost 50,000 you can save every year towards both API charges and trading bot. Of course, if you do not want to open an account using my referral ID and want to have this bot using your existing trading account, then you can still go ahead and purchase this on subscription basis. Cost would be generally 2000 to 3000 rupees per month, so you end up paying around 25,000 to 30,000 per year. You can still go ahead and have it, but again, as I said, if you are a small trader, I wouldn't recommend this. And if you are a big trader who has a capital of more than 10 lakhs, then you can go ahead and purchase this trading bot. Anyway, now we have covered the first topic, which is how to increase profits after this peak margin rule. And then the second, and I know this is the most important and most awaited topic, how small traders with 1 lakh capital can trade going forward after this peak margin rule. I have been hearing so many ideas. First is pledging. If we pledge our equity shares, then we get some amount given by the brokers. We can take that capital and then do intraday trading or delivery trading, whatever you want. And then the second is making use of margin benefit. If you hedge your position in options, then you get some margin benefit. That's another option that I've been hearing from many traders. One is pledging, second is hedging. Let me explain you these two things in detail now. First of all, pledging. Yes, if you are a long-term trader, then please go ahead, pledge it, and you can get extra money. You can use that for trading purposes. But if you are trading in PDR strategy, which is another strategy in my blog for short-term equity traders, please do not consider making use of this pledging option. No, there are so many side effects of this, and I'm going to explain you in detail all of them. So if you are doing PDR strategy, please do not use this capital for ISS. Four main drawbacks of using this pledging is: first one, haircut. There is something called haircut which is implemented by brokers when you pledge your shares. Let's say a share is worth 100 rupees. You bought it, you are holding it, and now you want to pledge this share and get some capital to use for your trading purpose. When you pledge this share, first they see whether this is of A category stock, B category stock, or C category stock, what's the quality of the stock, and based on that, they implement some haircut. So let's say you bought a company from a mid cap stock which falls into B category and it's not from Nifty 50 stocks. In that case, there is a high chance that the haircut would be around maybe 20% or 15%, which means you only get 80 rupees for this pledging. So for every stock that you pledge, you only get 75 to 80% of your capital. And then the second is pledging cost. Every time you pledge a share, broking firms generally take 50 to 60 rupees per stock, irrespective of quantity. You can pledge any number of shares, but they charge 50 to 60 rupees per pledge. So if you do it for 10 stocks, because in PDR strategy, we generally enter into 10 stocks every month. If you pledge all 10 stocks, generally firms charge around 60 rupees into 10, which is 600 rupees. And every month you do this, so 7,200 will be your cost for the entire year. You need to take into account all these small costs. This is the problem with so many advisors. They don't consider all these costs, which make up a big expense at the end of the year. And then the third and the most important is, when you enter into this PDR strategy, generally we enter on first of every month, right? On that particular day, shares are not moved into your DP. Shares are moved to your demat account only after a day. In some cases, it will be more than that. But for the sake of explanation, let me say that it takes at least a day. So if you purchase stocks on first, you cannot pledge it on first. It will be moved to your demat account on second. Now, even on second, you cannot use this amount for trading purpose, because on second you can pledge, yes, but that amount you get only next day. So on second, even if you pledge, you only get capital to trade on third, which means every month, first and second trading day, you cannot use this capital to trade in ISS strategy or for other instruments. So how many days we are losing? We are losing 2 days every month. And out of 20, or let's say 22 trading days per month, you are not trading 2 days, which is 10%. So ideally, your profits should also come down by 10% at the end of the year, right? Let's say you are getting 50% profit after this peak margin rule, if you're not using this trading bot, of course. Now, because you are getting amount from pledging the stocks of PDR strategy, you are going to lose 2 days of trade every month. So your profits will come down to 45% at the end of the year, which is again a drop of 10%. Initially, when I thought about all these things, I wanted to prove this strategy, whether is it really happening or not, because we are losing out first 2 days of trade, right? Are we losing 10% of the profits, or more than that, or less than that? Just to validate my theory, I went back to my backtesting report, took first trading day and second trading day profit and losses of ISS strategy, and then I collated all those P&L reports, and it's proved that we are losing around 12% profits in ISS strategy if we pledge these PDR stocks. So this proved to be right. So the third is loss of two trading sessions. We are going to lose 2 days in every month. And fourth one is, you are using the same capital for two strategies, which is never a good idea, especially from money management perspective. It is not a wise idea to trade in two strategies with just capital of one strategy. So fourth one is money management. Because of these four reasons, I wouldn't suggest you to go ahead with pledging if you are using PDR strategy. Of course, if you are a long-term investor and you have shares in your demat account already, then you can absolutely go ahead, pledge them and use it for trading. But remember, even in that case, you are not following proper money management concept, but still that is okay as long as you are a complete long-term investor. But if you are using PDR strategy, I highly suggest you not to follow this pledging concept. All right, I know I spoke a lot, but this is absolutely necessary for people traveling with me in this trading journey. And then the next is hedging. Let's talk about hedging. Margin benefit. This is the topic that I have been hearing from a whole lot of clients for the last 4 to 5 months. Everybody is saying that we will go ahead and purchase deep out of the money call or deep out of the money put so that we get margin benefit. For those who do not know about this, let me give you a quick background. All right, this is option chain. And what we are going to do is in ISS strategy, as you all know, we sell a call and a put which is at ATM, right? Let's see what's the margin required for that after this implementation of peak margin rule. I just open Zerodha margin calculator and let me go back. 14,950 is ATM strike price. Let me enter 15,000. So we are selling a call option and we are selling a put option. So 1,87,000 is the margin required going forward for both intraday and NRML. That's exactly what this peak margin rule says. You cannot avail any sort of extra margins apart from this. All right, now what this margin benefit rule says is if you hedge your positions with options buy, then brokers will not charge those hefty margins. Now, let's say you are selling this put option. For option sellers, obviously, risk is unlimited. So, what these brokers are saying is, or what margin benefit says is, if you hedge your position, which means if you buy another put which is out of the money, then your loss is capped, right? So if you're good with options, you know that if you hedge your positions, you cannot run into loss beyond a certain number. So that's the reason brokers say that if you hedge your positions, we know that your loss cannot go beyond certain amount. And for that reason, we will give you some margin benefit, which means the upfront amount that you're going to pay will also be very less. Let's say you want to sell 14,900 put. Instead of taking this naked put, which costs you around 1 lakh or 1.4 lakh, you will also buy this 14,000 put, then your margin will come down from 1.4 lakh to probably 70,000 or 80,000. Approximately 50 to 60% discount you will get if you hedge your positions. Let me show you that. So let me cancel call option. So here we only have 15,000 put option. As you can see, you need a margin of 1.65 lakh. Now immediately if you add 14,000 put, but instead of sell add buy here, your margin came down to 90,000, which means you got a discount of about 75,000 rupees. Why you are getting this discount? You are getting this discount because brokers already know the maximum loss that you get if you hedge your position. So this is called margin benefit. Now, what people are thinking is in this ISS strategy, or for that matter, any option seller who is trading in short straddles or short strangles, they are thinking that anyways, I will sell this ATM call option and put option. Apart from this, I will also be buying a deep OTM put option and deep OTM call option so that your margin comes down from 2 lakhs to let's say 1 lakh, which is true. But people are not taking into account the expenses or the operational cost that they need to bear if they do this. First, I'll show you the margin benefit that you get if you do this, and then I will walk you through some of the calculations part here. And remember one more point, if you come closer and closer, then your margin benefit will further come down. Initially, we saw that we need 1,65,000 if you sell naked option. But if you introduced this buy, it came down to 91,000. If you take this might come down to 85,000 or let's say 75,000. And if you take this might come down to 50,000. So if your call and put options are closer, then the margin requirement will come down further and further. But the problem with this is most of these are going to expire worthless, which means you are going to lose this money at the end of the week during expiration. So you need to ensure that you do not pick options which have high premiums for hedging purposes. So a reasonable strike price to consider is first we will sell call option put option and then pick the call and put option which are around 10 rupees. This way you can reduce the capital requirement from 2 lakhs to 1 lakh, and at the same time you will not lose much also. Let me hit reset, pick options, Nifty. So first, let's say you are selling a call option and a put option. And as we discussed, for put, you need to go at least 1000 strike prices away and then buy that. And for call option also, let's say you need to go 1000. Generally, in case of call options, you don't need to go 1000 strike prices away. Let's say you went 800 strike prices away. All right, now if you see, your margin benefit came down from 1,87,000 to 1,13,000. But remember, when you are doing this in real time, first you need to buy deep out of the money call and put options, and then you need to pick the options that you want to sell. Only then you get the margin benefit. So there is a sequence you need to follow to avail this margin benefit. And one other point, there is a small trick which you can use and get this margin further down. That is by adding one more call option and put option, which is deep out of the money. Let's say you still do not have this 1,13,000 rupees. So what I'm going to do is, these are buys, right? So let me delete these two and add them again. But this time I will add two lots. So call, I'm adding two lots. All right. And now let me add put, which is 14,000, again two lots. All right. Now if you see, our capital of 1,13,000 came down to 75,000. So from 1,80,000 or 1,90,000, you are able to get this down to 75,000. But what's the drawback? The drawback is now you have one lot of call and put selling and two lots of deep out of the money call option and put option which you purchased. So this is one lot, this is one lot. Again, most of the months, 90 to 95% of the months, this will expire worthless. So here 11 rupees into 2, which is 22 points you are going to lose. And here also maybe 10 points into 2, 20 points you are going to lose. Which is okay. We cannot do anything. If you want to avail margin benefit, you need to follow this. But I'm going to give you one very valuable tip here. You need not do this every single day. Okay, if you want to avail this margin benefit, then what I suggest you is, you take these deep out of the money call option and put option on Friday morning, or you can also take it Thursday before market closing, 5 minutes before Thursday market closing, and leave it like that. What this does is, this will help you reduce your operational costs a lot. If you do it every day, enter in the morning and then exit in the evening like intraday short straddle, if you do it every day for this deep out of the money call option and put option, that's going to increase your operational costs a lot. When I say operational costs, your brokerages, STT, transaction charges, and all those. Don't do that. That will add a lot of other expenses into your account. And some people ask me, sir, if I take this deep out of the money every day in the morning and exit every day in the evening, then I will not lose this 11 rupees entirely. That is true. If you do it every day, you might not lose this 11 rupees every day. Maybe you lose 2 rupees every day, which is still equal to 11 rupees for a week, right? So there is no point in losing 2 rupees every day and making it up to 10 rupees or 11 rupees plus paying extra charges. So what I would suggest is, don't do intraday trading with this deep out of the money call and put option. Okay, now I told you how to reduce the margin, but let me tell you, you are not going to benefit with this. Why you are not going to benefit is, let's say you bought one deep out of the money call option and one deep out of the money put option. 75 shares that we have in Nifty per one lot, into, you are going to lose 10 points on the call side and 10 points in the put side. So 75 into 10 here, okay, which is 750 rupees you are going to lose per week for call option, and 750 rupees you are going to lose for put option, which is 1500 rupees per week. And we have 52 weeks. So if you multiply this by 52, that comes close to 78,000. Can you believe this? Unfortunately, most of the people are not considering these options which are expiring worthless end of the week. Everybody is talking about margin benefit that they get. But you need to understand this. You are simply going to lose 78,000 rupees per year, which means for a capital of 1 lakh, you are giving away 78% of the profit upfront. And of course, apart from this, you will at least sell this once on Friday morning, right? You need to pay brokerage and transaction costs for those deep out of the money at least once per week. So that will still cost you around, let's say, 5,000 or 6,000 rupees. So this will become around 84 or 85%. So 85% of the profits you are going to lose upfront. So even in ISS strategy, you get 100% return. If you are losing 84%, then your overall profit will be 16%. So for 16%, you need to take a lot of pain. So what's the right way to earn profits if you have capital less than 1 lakh? First thing, let me tell you, I wouldn't suggest you to do intraday short straddle or strangle anymore if you have capital less than 1 lakh. Please ensure that you have 2 lakhs, and then I can give you a strategy that can simply earn 70% returns or even 100% returns easily every year. However, if you do not have 2 lakhs, I will still go ahead and tell you a way or a strategy to trade. But remember, this strategy you have to use and come out of that 1 lakh bucket and fall into 2 lakh as soon as possible. Remember, the strategy that I'm going to tell you is a little difficult in terms of operations. You need to continuously monitor margins in your account and ensure that you have enough capital. So please use this strategy only a way to come out of this 1 lakh bucket and reach 2 lakhs bucket as soon as you can. Once you reach there, then it will be very easy. There are n number of ways that you can earn money once you reach to this 2 lakh bucket. So let's see how you can earn money even with 1 lakh. Let's say your capital is 1 lakh and you earn 1 lakh in ISS strategy. I mean, at least till date it is possible, right? Without peak margin rule and all. Now, if you introduce this margin benefit concept that I told you, then you can still go ahead and earn this 1 lakh rupee profit with 1 lakh. But the problem is you have to pay around 85% or let's say 85,000 towards all the costs. Now, what you need to earn is you need to earn approximately 1.9 lakh to 2 lakhs so that you can give away costs of 85 to 90,000 and then still earn 1 lakh rupee as part of the strategy. So let me tell you a way how to do this. Instead of your money working in one shift until now, it's going to work for you in two shifts going forward, which means you continue with ISS strategy every day. You enter around 10 o'clock and you exit at 3 o'clock, 3 p.m. Right? All these we have seen in part one. Now, this is day trading. Now, apart from this, what you are going to do is you are going to deploy another strategy which will make you money overnight as well. After 3 p.m. until next day morning, your money sits idle in the account, right? What you're going to do is again at 3:15 p.m. you are going to sell intraday short straddle once again and you exit that around 9:20 or 9:30 a.m. So this way, what happens is if you continuously do this every single day, you get 1 lakh in day trading and you get 1 lakh in BTST or STBT. All right, as usual, as you know, I only rely on numbers since I'm a data scientist. So as always, I came back with some numbers. Look at this. All you are doing in this is you are entering at 3:15 and then you are exiting next day. If you look at this, we are exiting only next day at 9:20 or 9:30. And then the parameters that I used here, selling a call, selling a put. But again, remember, Even with this, you need to have trailing stop loss. Only then it will be profitable. If you do it without trailing stop loss, leave about profitability, but you might face some huge losses. You need to keep that in mind. So always go with trailing stop loss, and stop loss should be around 40%. If you go with these settings, then you can see that you earn around 1,80,000 rupees. And since this is for 2 years, you can see that I have entered this data for 2 years. So if you divide this by 2, every year you get a profit of around 90,000 rupees for your overnight position. So while the day trading gives you 1 lakh profit, overnight strategy also gives you around 90,000 rupees profit. And the drawdowns are also okay in this case. You are going to face around 27,000. But remember, if you combine these two strategies, your drawdowns come down. Generally, whenever you are doing in multiple strategies, your drawdowns obviously come down. That's the reason we say diversification is very important, because in one strategy you get a profit and in another strategy you get a loss. Obviously, it's no profit, no loss. Let's say tomorrow in B strategy you got a loss and in A strategy you got a profit. Again, it's no profit, no loss. So if you combine multiple strategies, generally your drawdowns come down. So if you include these two strategies into your trading system, then there is a chance that your overall drawdown comes down. Okay, so with this simple change, you can earn around 70,000 to 1 lakh over a capital of 1 lakh. But again, I'm telling you, you need to use this strategy only as a way to come out of this, because there are a few drawbacks with this strategy. One is you need to check margin requirement in your account every day. On daily basis, you need to check this. What happens is we have seen the option chain rate. Let's say this is the option chain, and here we have ATM. And deep out of the money, you are purchasing a put option and then another call option. Now, let's say this is 15,000 rupees, this is 14,000 strike price, and this is 16,000 strike price. Now, if market is at 15,000 rupees, then that's fine. You don't need to do any sort of adjustments for that entire week. You just buy a call option and then you buy a put option. But if markets are moving radically, let's say from 15,000 rupees, markets came down to 15,800. In this case, you don't need to touch this, because it's good that you already bought 16,000 call option, and so your margin benefit for call side will be very less. However, now your distance on the put side is 1800 points. Market is now at 15,800 and this is at 14,000. So again, your margin benefit will not help you. It shoots up. The margin requirement will be so high. Now again, you need to buy another put option which is probably around 14,800. Okay, because again this is a gap of 1,000 points. Leave this one, you don't need to touch this, because by this time already this would have become 1 rupee or 2 rupees. There is no point in selling it back. But what you have to do is you need to again buy one more deep OTM put option. So you need to do these sorts of adjustments all the time throughout the year. It is not difficult. At the same time, it is not very comfortable as well. Just you need to spend like 10 to 15 minutes every day to check whether you have enough margin or not in your account, and whether this margin benefit is kicking in or not. That's the first point. What's the point? You need continuous monitoring. And then the second is overnight positions. Remember, you are holding overnight positions and anything might happen overnight. Let's say tomorrow there is a missile attack from one country on another country. Markets might fall 1,000 points or 2,000 points. You never know. Of course, one good thing is we do have a protection. If you do not have even this protection of deep OTM, you probably might lose entire amount in your account. Since you have this protection, even if there is a missile attack, you will not lose completely, because the maximum loss is capped. You might lose maybe 50% of your capital in one single day. Chances of happening this is very rare, but there is a possibility. So you need to ensure that when you are holding these overnight positions, if you know that there is any big news that is coming up, you better avoid overnight positions for that one day or one week. Okay, let us say there is a war going on. you can avoid taking overnight positions for that one particular week. Or let's say there are some important economic numbers that are coming up next day, like GDP. In that case also you can avoid overnight position. So whenever you have these huge events, it's always preferable to avoid these overnight positions. So these two things you need to consider and monitor continuously, so that you still end up in gaining around 70 to 100% profits in this ISS strategy. Or for that matter, anybody who is trading in short straddles or short strangles, you can follow this method to earn decent money at the end of the year. But again, let me repeat myself, you have to use this strategy only if it is absolutely necessary, or if you do not have 2 lakhs. If you have 2 lakhs, I highly suggest you not to follow this. You have other ways of earning safe and cool money in stock markets. But if you have 1 lakh, use this as a catalyst. Trade using this strategy until you reach 2 lakh and come out of this completely. Okay, I know this has become a very long video, but trust me, this is absolutely necessary if you are an option seller. And finally, if you do not want to take all this pain, please let me know. I'll give you free trading bot. All you have to do is just sit back, relax, let the bot trade on your behalf and enjoy profits. And talking about the bot, as I said, it is very, very advanced. You can simply log in from your mobile and just place orders. Let me show you a glimpse of it. This is a simple trading bot. All you have to do is just hit on this red color and blue color buttons. It will ask you whether you want to enable or disable the bot. You can see the status as well. If it is enabled, then your bot is running. If you hit on this red button, it will disable you and shows the status as disabled. That is all you have to do. You have Nifty, you have Bank Nifty. You can select whichever instrument you want. If you want to change the parameters, you can change all the parameters here. It is absolutely automated, completely 100% fully automated trading bot. You just have to enable this bot and go back to your work. And what's more interesting is you don't need to switch on this bot every day also. We know your priorities. Since you are very busy, we developed this bot in such a way that the bot will come, checks the entry time every day in the morning, and then it executes your trades. You don't need to switch on the bot every day as well. You switch on the bot, and until you switch off the bot after 1 year, 2 year, or 5 years, the bot continuously keeps trading in your account. Only thing that you need to ensure is you have enough margin in your account. That's all you have to do, and the bot does all the trick for you. And especially for those who have 1 lakh and want to follow the strategy that I just mentioned, this bot is extremely helpful, because in this strategy you need to take care of day trading, you need to take care of overnight trading, you need to trail the stop loss whenever markets move in your direction, and at the same time you also need to take care of margin benefit, right? If you have this bot, 95% of the work is done by this. It will take care of your day trading, it will take care of your overnight positions, it will take care of your trailing stop loss as well. All you need to do is just spend 5 to 10 minutes every day and ensure that you have enough margin in your account. That's the only thing that you have to do. So whoever is planning to increase their capital from 1 lakh to 2 lakhs, then this bot is a must. If it is not this bot, then make use of any bot. You can build your own trading bot as well, but please don't trade manually. There is no way that you are going to earn money if you do manual trading in the strategy that I just mentioned. Okay, lastly, if you want to connect with me, you can connect with me through any of the social handles. Especially, I prefer Telegram. If you haven't joined, please join my Telegram group, because I can easily convey with all my clients through Telegram. So please join my Telegram group for all interesting strategies and articles, or otherwise you can also contact me on any of these social handles. Finally, if you haven't subscribed to this channel, please subscribe and hit on bell icon. Thank you and see you in the next video.